Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to our latest webinar with Jim Rickards in the series we're calling the Gold Chronicles. Jim Rickards is a New York Times best-selling author and the chief global strategist for West Shore Funds. He's the former general counsel of Long-Term Capital Management. He's a consultant to the U.S. intelligence community and to the Department of Defense. He's also an advisory board member of Physical Gold Fund. Hello, Jim, and welcome.
Hi, John. Great to be with you. And
we also have with us Alex Stanczyk, Managing Director of Physical Gold Fund. Hello, Alex.
Hi, John.
Alex will be looking out for questions that come from you, our listeners. So let me just say that your questions for Jim Rickards today are more than welcome. You can post them at any point during the interview. You'll see a box on your screen for typing in your question. So, Jim, let's start in Lima, Peru, where it is IMF week. Twice yearly, the IMF and the World Bank hold several days of meetings. Could you begin by giving us a brief refresher on the IMF, what it is, and why these meetings matter?
Sure, John, I'd love to. Let's do a little IMF history, and then we'll bring it right up to date in terms of what's going on in Lima, Peru right now. By the way, just as an aside for listeners, this is neither here nor there, but I went down to Washington last Friday, actually working with some national security people on a new, we do these war game scenarios. They're not financial war games, that is. They're not all quite as elaborate as the one I did in 2009. Sometimes it's just one day or whatever, but I was going down for one, as I say, in Washington, and Madame Lagarde, the managing director, head of the IMF, happened to be on my flight, and we were all sitting together. I didn't have the occasion to speak to her because she had two bodyguards and a couple assistants and a small entourage, but I was sitting right behind her on the plane. And she's as elegant in person as she is on her on TV or in pictures, and quite tall, walks fast. But actually, when we stood up on the plane, normal airplane etiquette, we all got out in the aisle. We were in first class, and I actually got out between her and her bodyguard. And her bodyguard was not pleased with me. He almost knocked me down, getting into his protectee, but did have at least a kind of a fun encounter with the head. But yeah, going back to the origins, of course, the IMF is one of the big three Bretton Woods institutions. Of course, the Bretton Woods conference was in July 1944 up at the Mount Washington Hotel in Bretton Woods, New Hampshire. Very remote area, by the way. Still is. I was up there a couple of years ago doing, actually, it was another financial war game with the Boeing Corporation, and they just picked the Mount Washington Hotel as their venue. Beautiful spot, but it's still a remote area, but certainly was in 1944. It was toward the end of World War II. At that point, the Allies could see victory. Victory was not in hand. It was just literally weeks after D-Day. Allies were pushing towards Paris, but the war was not over. But they were looking through the end of the war, expecting victory at some point, and saying to themselves, well, okay, victory on the battlefield is fine, but we're going to have a world economy to run after that. We could see that the interwar problems, the problems after World War I, German reparations, the Great Depression, the original, what I call currency war, beggar thy neighbor devaluations, all these things, these financial developments had contributed to World War II, made Germany's burden more difficult. It was never quite satisfactorily resolved, created resentment on the part of the Germans, and in different ways led to World War II. So they said, well, let's not repeat that mistake. Let's have a better post-war system. And there were a lot of institutions. The United Nations was one of them. That was a different conference, but that was one of them. But on the financial side, Bretton Woods was the place where, really led by the United States, they created the architecture for post-World War II economy. And there were three big institutions that came out of it. One was the IMF, the International Monetary Fund, which is what we're talking about today. The other two, the World Bank. And the third one was, at the time, the General Agreement on Tariffs and Trade, trying to tear down tariff walls and tariff barriers. That has now morphed into the World Trade Organization, the WTO, but it's still, again, one of the three pillars of the post-war financial order. So let's talk specifically about the IMF. Originally, it was kind of a swing lender. It was sort of a credit card for countries that were having balance of payments difficulties. Remember, at the time, from 1944 to 1971, the world was on a gold standard. Had some problems, but it was a pretty solid gold standard. Well, what that meant was that if you were running a trade deficit, your trading partners could take your money that they had earned by trading with you and cash it in for gold. Well, there wasn't enough gold to go around, at least not at $35 an ounce. And countries were running chronic deficits, which meant that they could ultimately lose their gold. So the IMF was there as a swing lender. So the IMF would say, well, look, we will lend you the money you need to, in dollars, basically, the US dollar, to satisfy your creditors for the time being, because the dollar was as good as gold. It was tied to gold. But we expect you to make structural reforms, do something to improve the situation, improve, lower your unit labor costs, improve productivity, impose taxes if you need to balance your budget, do whatever you need to do. So the IMF was there as a short-term lender in exchange for structural changes that would, in theory, solve the problem. And then you could get back to trade surplus. That was the idea. It worked fairly well in the 50s and 60s, but then, of course, it all broke down in the late 60s, mainly because the United States did not hold up its end of the deal. It's one thing to help all these other countries that are trying to tie to the dollar, but the U.S. was not on a sound fiscal basis. We had the twin deficits coming from a trade deficit, first of all, and then Vietnam. We were running budget deficits to pay for the war in Vietnam. And, of course, I think most of the listeners know that the system broke down in 1971 when President Nixon ended the convertibility of dollars for gold. Interesting what he did at the time. He said it was temporary. And I actually spoken to Paul Volcker about this, and former Chairman Volcker confirmed that. He told me, he said, I'm not sure I would have gone along with it if I'd known it was going to be permanent. We thought it was going to be a temporary suspension, and we could get back to a gold standard, maybe at a different dollar price. And that's kind of, I think, what they expected. But as it was, it turned out to be permanent. Well, that takes us up to kind of 1971. Then from 71 to 80, you had sort of a confused period where the world didn't know, are we going back on a gold standard, off a gold standard, fixed exchange rates, floating exchange rates, and so on. And that was a fairly tumultuous period of borderline hyperinflation. The IMF was at that point a forum or a place where major countries could get together to work out new rules of the game. And they eventually did. They said, okay, now we're going to have floating exchange rates. We're going to go off the gold standard. And they officially demonetized gold in 1975. A lot of people say the gold standard ended in 1971. Well, that was the time when President Nixon ended convertibility, but the gold standard didn't officially end until 1975. Then what happened next was you kind of get up to 1980. From 1980 to 2010 was a period of where the IMF didn't clearly have a mission. And at least I'll say from 1980 to 2000, the old mission of being a swing lender to deal with balance of payments was over, because you didn't have to worry about balance of payments anymore in a world where there was no gold standard and no fixed exchange rates. There wasn't a lot for the IMF to do, but they did come up with a new role for themselves as a lender to emerging markets. This is the period of the Asian tigers and high growth in Taiwan, Singapore, Korea, and elsewhere. But those countries would occasionally get into difficulty, and the IMF could come along and help them out. But then that role, sort of like the fire department coming around putting out fires in emerging markets in the developing world, that role blew up in 1997, 1998 with the emerging markets crisis, where I think most observers, most prominently Joe Stiglitz, said that the IMF role was badly flawed, that a lot of their advice, they would come into a country that was running balance of payments deficits and budget deficits, and they would lend you the money to deal with your deficit, but then they would say, okay, you need to raise taxes, you need to cut public payrolls. It was basically an austerity type of prescription, the same kind of thing that's being complained about in Greece today. A lot of people took the view that that made matters worse. But at the time, the IMF was very, very opposed to exchange controls. They said, no, you have to keep an open capital account. And it was the people with their money, you have to give it to them, but we'll lend you the money to help kind of make those payments in exchange for all this austerity. But the case could be made that austerity only made things worse, and that maybe exchange controls were not a bad idea in certain cases. And the most prominent voice for that point of view was Prime Minister Mohammed Mahathir of Malaysia. He very famously got into a shouting match with the IMF and George Soros at the 1997 annual meeting in Hong Kong. We're coming up to the the Lima annual meeting right now, but they've done this every year for a long time. And the Hong Kong meeting in 1997, I was actually there in Hong Kong for that, and that was one where this all sort of came to a head. So that brings us up to 2000. So now the original Bretton Woods mission of being a swing lender under the gold standard is gone. The fixed exchange rates and the gold standard itself are gone. The emerging markets fireman kind of role, if you will, was discredited. So in the early 2000s, it actually looked, the IMF looked like an agency without a mission. It looked like they had nothing to do. I mean, they had experts. They would write studies and do what they call Article 4 consultations. And Article 4 consultation is when they come into your country and they meet with your finance minister and your various officials and look at what you're doing about your exchange rate. And they give you a report. Again, this is called the Article 4 consultation. So they were doing that, but there really wasn't a lot to do. And it was a period of very solid growth in emerging markets. The developed economies weren't growing quite as fast, but they were growing. No inflation to speak of. The world seemed like a pretty stable place financially. This was the period that was called the Great Moderation at the time, meaning moderation in deficits, moderation in inflation. So there was some talk by 2005, 2006, maybe we ought to disband the IMF. It doesn't look like they have anything to do. But then that all changed, of course, in 2007, 2008 with the global financial crisis. Now the IMF took on a completely new role. So you have to give the IMF credit for reinventing themselves. They've had at least 4 different persona, if you will, 3 of which I've mentioned. But this new one was really a secretariat for the G20. Now, the G20 had been around. This is a group of 20 nations, but most important financial decisions in the international monetary system had been made prior to that by the G7. The G7 were the 7 largest developed economies. So U.S., Canada, France, Germany, U.K., Italy, Switzerland, Japan were all in it. And that had been the main forum. But by 2008, with that panic, it was clear that because of globalization, because of the rise of China, because of the BRICS, you could no longer make it an exclusive rich country club. You had to include developing economies, including important ones, obviously, like China. So that broader platform was the G20. President Bush and President Sarkozy of France convened a G20 meeting in Washington in November 2008. Think about November 2008. You're talking just weeks after Lehman, AIG, collapse of markets around the world. And this was a pretty desperate time. And the G20 started working on a plan which played out in subsequent meetings. London, April 2009, Pittsburgh, September 2009. There was a sequence of meetings where they worked out the currency wars, basically what became the weak dollar in 2011 and the strong dollar today. Well, the G20 is fine in terms of heads of state, but they had no permanent staff, no expertise, no research department, no bureaucracy. There was just a bunch of leaders who got together. So in effect, they outsourced the hard work, the monitoring, and the research to the IMF. So the IMF became, in effect, as I say, the bureaucracy bolted on to the G20. Well, this is a very powerful role because the G20 were heads of state. I mean, it was President Bush, then President Obama, President Xi of China, and other heads of state. So a very powerful organization, still is. So now the IMF has evolved into probably its most powerful role ever, considering 10 years ago people were talking seriously about disbanding it. Today, it is the de facto central bank of the world. They have gold. They have 3,000 tons of gold. They're expanding their balance sheet by issuing liabilities and creating assets in the form of loans. They have their own currency, the special drawing right of the SDR. They can print as much of it as they want and hand it out. I expect that they will in the next crisis. So they are, to all intents and purposes, a functioning central bank of the world. And the bureaucracy, if you will, the G20, which is the board of directors of the global economy. So I don't think any of that is an exaggeration. It's really what they've become. So a very, very powerful organization. And that brings us up to today, which is the IMF. Is in Lima, Peru. They have 2 important meetings: an annual meeting in October and a spring meeting, usually in April. The spring meeting is always in Washington, and the annual meeting floats around. This year it happens to be in Lima, Peru, so a lot of your household name financial elites, Joe Stiglitz of Columbia, and in addition to Madame Lagarde and other finance ministers, some central bankers are all down there now with quite an ambitious agenda. We'll be hearing a lot about it in the next 2 weeks.
Well, thanks for that recap. It's actually really helpful not only to sort of get the definition, but get the historical context. Bringing it up to date then, in this year's meeting, there's been quite a lot of buzz about the meeting, and the IMF has been pretty vocal. They've been putting out some strong alarm signals on several topics. Maybe we could take them one by one. First off, the state of the world economy. Growth is below expectations, and there's particular anxiety about Chinese manufacturing. US job numbers, even with the rosier spin, which we see plenty of, are disappointing. Can you tell us how seriously we should take this economic hand-wringing by the IMF?
Well, we should take it very seriously, both because they have the expertise. So they have a lot of smart people, a lot of PhDs, and quite a few graduates actually of my old school where I got my graduate training in international economics, the School of Advanced International Studies, part of the Johns Hopkins University, but main campus of Johns Hopkins is in Baltimore, but what's called SAIS, SAIS, the School of Advanced International Studies, is in Washington, D.C., and that you can think of it as intellectual boot camp for the IMF. It's where people really from around the world, not just U.S. students, but from all over the world, go. Fairly small group, about 300 students. Tends to have some fairly elite experiences coming out of finance ministries and elsewhere around the world. So they feed into the IMF. I graduated from there in 1974. A few years later, one of our prominent graduates, a fellow named Tim Geithner, came through, and he went to work for the IMF. Later, of course, president of the Federal Reserve Bank of New York and secretary of the Treasury. So that's an example of the kind of training you get there in all this. But yeah, so I do think the IMF, what they do is important, should be taken seriously. They do have the expertise, and then this added role that I described earlier about being kind of at the beck and call of the G20, if anything, enhances their clout. Now, they have, I've always said about the IMF, and maybe the listeners have heard this before, but they're what I call transparently non-transparent. And let me explain what I mean by that. When I say transparent, or they act transparently, they put everything on their website. You can go to the IMF website. It's easy to find. And if you browse around a little bit, you'll find the World Economic Outlook. You'll find the Global Financial Stability Report. You'll find a lot of these papers. You'll find the famous paper from 2010 that 2011 rather, that lays out a 10-year plan to evolve the special drawing right into a world currency, how you would actually do that. So there's not much that they do that you can't find out about on the website, but good luck understanding it. It is written in very dense jargon, even more dense than the kind of jargon we're used to seeing from the Fed. A lot of buzzwords that if you're expert in the international monetary system, it'll seem familiar to you. But if not, if you're just kind of a smart and interested person, you'd like to go learn more, it's tough to get through. So the stuff is there. So I give them credit for putting it out there. But as I say, good luck, kind of understanding it all. So that's where, again, the kind of specialized training that I received and others have received is helpful, because you can kind of sometimes I think what I do, I'm like a translator. I read these really technical reports, and I have some ability to put it into plain English for the audience. So I feel like a missionary going out, exploring the territory, and coming back and reporting back. But that's a part of what's going on. Now, you mentioned some of the reports that have come out this week, John, and you're right, let's take them one at a time. The World Economic Outlook is the one that gets the most attention. It's basically a forecast for the entire world. They go country by country, but they also go region by region, and also for the whole world. They have been lowering their forecast. Now, I do have to say, the IMF has a pretty bad forecasting record. They've got talented people, but they have the same problem the Fed and others have. They have consistently overestimated growth for the last 7 years. Now, this is kind of endemic. You see this everywhere. As I say, you see it from the Fed, you see it from Wall Street, you see it from the IMF. They say 3%, turns out to be 2%. They lower their forecast to 2.5%. It turns out to be 1.8%. They've just consistently overestimated growth. And there are reasons for this. I don't think it's some deep, dark conspiracy where they're trying to lie to people. I think they've just got obsolete models. They're using regressions that deal with business cycles and business expansion since the end of World War II, and there have been over 30 business cycles, and they've got all that data, and they, as I say, they do the regressions and the correlations, and they say, well, based on where we are now, we ought to be growing at such and such a rate. And there are some other factors that go into the factor analysis. The problem with that statistical methodology is that it doesn't apply. It doesn't apply because we are not in a cyclical recovery. We are in a growth depression, really the first global depression since the 1930s. So you can have a lot of data, but if you're in a different world, different situation, that data is not going to tell you very much, and that is the situation we're in today. So I use very different models. I'm using complexity theory and inverse probability and some economic history and behavioral economics. I'm using a lot of other things to get my forecast, but I can see where the IMF and the Fed go off track. So on the one hand, their forecasting record is pretty poor and they've overestimated growth. So I see no reason why they're not doing that again. On the other hand, they have lowered their growth estimates, almost as if they're learning by doing. You know, if you sort of get hit in the head with a 2x4 enough times, you'll learn to duck. And so both things are true. I still think they're overestimating global growth, but they did lower the forecast to about 3.1% for the world in 2016. That's not a lot when you consider that economies like the emerging markets, places like Brazil, Russia, China, India, other important economies not quite as large, Turkey, Malaysia, places like that, when you consider that their potential growth can be 5, 6, 7%, and the world is only growing at 3.1, that's a pretty sad story. Now, the U.S. does not have potential growth of 7%. Maybe in the very short run that's possible, but it's unlikely. The central tendency for U.S. long-term growth, it's higher than we've been doing. I think it is sort of 3.5%, but we've been doing around 2% since the end of 2008. But for global growth to come in at 3.1%, that's pathetic given the high potential growth in a lot of the important economies around the world. So that tells you how weak things are. But based on what I just said about their forecasting methodology, it could be worse than that. I mean, imagine global growth coming in around 2% or 2.5%. That means that the big emerging markets economies probably come down to 4%, and the developed economies are getting closer to 0. I mean, that is what that implies. And so I think this is a pretty sobering, pretty dour forecast. But, give the IMF credit. They're not sugarcoating it, and they're warning the world that the slowdown is taking place. Which brings us around to the Fed, because when you say, well, okay, well, why is this slowdown taking place if there's all this potential growth out there, and you've got a lot of underutilized factors of production, whether it's labor or capital investment or infrastructure improvements, structural changes. If there are a lot of things you can do to get growth, why are we not getting it? What's the problem? Well, a lot of the problem I would trace back to the Federal Reserve. And you do have a kind of circular flow of cause and effect, John, because people say, well, gee, not just people, but Janet Yellen. So I'll just refer to her. Janet Yellen on September 17th, when the Fed decided not to raise their target for Fed funds, not to raise interest rates, in other words, she gave, which surprised a lot of people. It didn't surprise us and did not surprise the listeners in this podcast because we had said that all along, that they would not raise rates. But it surprised a lot of people on Wall Street. And she gave us a reason, the slowdown in global growth, exactly the kind of thing the IMF is talking about. And that has now, in effect, come back to the United States in the form of reduced exports and the strong dollar slowing U.S. exports, the strong dollar importing deflation from around the world in the form of lower import prices. At a time the Fed says they want inflation, they threaten to raise rates, which strengthen the dollar, which causes deflation. So the Fed's own policies were pushing in the opposite direction of the Fed's stated goal, something that makes no sense. And we said that months ago. We said this makes no sense. It's going to have to be resolved, probably to the detriment of the Fed. And it turned out that they were unable to raise interest rates. But so Janet Yellen blamed it on global growth and mentioned China specifically. Well, that's fine, but one of the reasons China was slowing down was because they had pegged their currency to the U.S. dollar. And the Fed has been tightening for 2 years, actually 2.5 years. And when I say that, people look at me like I have two heads. Like, what do you mean the Fed has been tightening? The interest rates have been 0 since 2008. We've never seen so much money around. They printed $4 trillion. How on earth could they be tightening? Well, the answer is they have been tightening since May of 2013. That's when Ben Bernanke gave the start of the taper talk. He didn't actually taper in May of 2013, but he said, we're thinking about it. Well, that alone, just saying we're thinking about tapering, of course, means reducing money printing. Under QE3, the Fed had been buying about $85 billion a month of Treasury securities, which meant that they were printing $85 billion a month. That's how they do it. They print the money to buy the securities. Well, he said, we're tapering that. Well, instead of 85 billion, we'll lower it to 70 and then 60 and then 50 and so forth until they got to zero. Well, a lot of people say, well, that's not tightening because you're still printing money. Well, it's true you're printing money, but if you're printing less than you did the month before, I mean, everything happens at the margin. Things don't happen in black and white in markets. They happen at the margin. Small changes change expectations and change various kinds of behavior. So by just talking about tapering, there was the taper tantrum, the emerging markets crisis. Capital started to flow out of emerging markets. Emerging markets currencies collapsed, the stock market collapsed, money started coming back into the U.S. Well, then in December 2013, they actually started tapering after talking about it for 7 months. Then in November 2014, they finished the taper, so now they were not printing any money at all. But they still had forward guidance in these statements saying, well, we in effect promised not to raise rates. In March 2015, Janet Yellen removed forward guidance. They took out the word patient. Remember the famous word patient? They took that out of the statement. So the Fed was no longer promising not to raise rates. They were saying, we're getting ready to raise rates. Anyone in a carry trade, anyone shorting dollars, anyone borrowing dollars to invest in emerging markets assets, you better watch out because we're going to raise rates and pull the rug out from under you on that trade. Well, people heard her. They started covering the short dollar positions. The dollar got stronger. There were huge capital outflows from emerging markets. So they were tightening. So even without changing rates, they were talking their way and acting their way through a tightening cycle for 2.5 years. Well, back to China. So you're China, you peg to the dollar, the Fed's tightening. What do you have to do to maintain the peg? Well, you have to tighten also. The way they were doing it is they had to buy their own currency. If the market wants to take the yuan down, if the market wants to lower the exchange value of the Chinese yuan, and you want to keep it up at a higher level, you have to go buy it. That's how you maintain the peg. Well, what were they using to buy it? They were using dollars. So they were selling treasuries, taking the dollar, buying their own currency from their exporters or anyone who had it to maintain the peg. That was causing huge capital outflows from China. That was causing the dollar to get stronger, but it was also causing the yuan to be too strong. The Chinese government was propping up the yuan. But at the same time, they were trying to ease because their economy was slowing down. So they were lowering interest rates to ease. So you had this crazy situation where they were easing and tightening at the same time, using two different policy tools. They were using interest rates to ease, and they were using exchange rates to tighten. What kind of policy eases and tightens at the same time? That makes no sense. So they eventually threw in the towel on the peg, famously broke the peg in August this year, let the yuan devalue. That started the U.S. stock market collapse. But my point is, this is all connected. It was the Fed blundered by tightening. The U.S. economy was not strong enough to bear a strong dollar. The U.S. economy was not strong enough to bear the tightening. So the Fed was not only tightening for the U.S., which was their first mistake. I mean, the time to tighten was 2010. They missed a whole cycle. They should have tightened in 2010, 2011, when we had the cheap dollar, which gave the economy a tailwind. They blew it. But two wrongs don't make a right. Just because you should have tightened in 2010 and you failed to doesn't mean that you should tighten today when the economy is getting weaker and the U.S. is probably heading into a recession. So they took the U.S. economy down. They took the Chinese economy down. The Chinese had to break the peg. And now here we are. The Fed is stuck with a strong dollar, deflationary tendencies, and they have no way out. So this whole thing is a mess, but it's working through the interest rates and the exchange rate mechanism. That's what the IMF is warning about. And the IMF, Christine Lagarde, just about a week prior to the September 17th meeting in Turkey at the end of the G20 Finance Minister Summit in Turkey, issued a warning that was as blunt as anything I've ever seen. There was no polite language around it. She just said to Janet Yellen, do not raise rates. And if you recall, the BIS, the G20, the World Bank, Larry Summers, IMF, everybody was saying the same thing to Yellen, do not raise rates. Well, she listened, and I think to her credit, she didn't. But that dialogue is going to keep happening. And so now the IMF is out again today, actually this morning, with the World Economic Outlook, saying, it actually came out yesterday, but I talked about today, saying in effect, hey, don't raise rates. The world is too precarious, growth is too slow. So that's one of the big statements they've issued. We could talk about some other ones as well.
You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.